There are new projections where billions of XRP could be gone over the next 12 months, sucked up by ETF demand for spot products. I did want to talk briefly about the Fed dropping interest rates in December. What is to be expected? What is the crypto market about to go through if the Fed decides to drop rates here? What is going to be expected? There's a lot of stuff that I want to talk on a macro level here to better understand where the market is heading. So let's do this first, and then we'll get into some of this XRP information.
Well, we're seeing breakouts in stocks like Apple and, of course, Google.
I love it, though.
So there's something for everybody. Caps today are working really well. We see the eco-weighted S&P. So it's not a bad time. The key is that we really need to accelerate, and that might take some time. I envision it's going to be a choppy time until the Fed, and then we can start to likely turn a little bit higher. So I don't think we're out of
December 10th could be the date.
I think we need to bide our time. There's no certainty in terms of a rate cut just yet, and there's a lot of job owning, and it's difficult.
What if we don't? What if we don't? What if we fail to break out? I mean, what's the risk on the downside?
Well, the risk is that we take out these lows. That is the most important level on the whole chart for bulls and bears. If that's broken, then we're going to make an equivalent leg of this down before we move up, which is likely mid-December into mid-January.
Okay.
So it's choppy. You know, there are things that are working.
And that's why you wait.
That's a good news.
And that's why you wait, because of the near-term vulnerability before the Fed meeting.
It's important to be diversified among tech and not just all in NVIDIA.
Same thing with MAGs. It's a very similar thing. Same sort of setup.
Yeah, I mean, obviously, if we get over 66.11, that's a great sign. Technically, we've broken a little trend and we can start to move higher. But here also, a lot of momentum to the downside. So I suspect it's going to prove choppy before we start to turn back up. And likely late December. Yeah.
All right, let's keep it going here. There's some additional things I want to talk about.
Why do you think this market can go higher even if the Fed does little?
Well, I think that if the Fed does cut rates, we'll have to watch what the bond market does, because last year when the Fed cut the Fed funds rate by 100 basis points, the bond yield went up by 100 basis points. I think much will depend on, the ongoing data here. We do still get initial unemployment claims. We got retail sales numbers today, which are a little bit on the weak side, and the PPI was not too hot. So I'm not committed, to this notion that the Fed isn't going to cut. I mean, I go with the market's perceptions right now, and so I wouldn't say that it's not going to happen. But I don't think it needs to happen for the market to go higher, because earnings have been phenomenally strong. First, second, and third quarters of this year, analysts expected low single-digit increases in earnings. They came in at 10 to 15%.
But you don't want the Fed to make a mistake, even if all of that is correct, right? I mean, you don't want them to make a mistake. The unemployment rate is up. That's got some people nervous. If they wait too long, they get way behind the curve. That's a mistake, and the market would pay for that.
Well, I think you're right about that, and that's apparently increasingly the perception at the Fed and increasingly the perception of the market. I think the labor market has problems that aren't necessarily going to be solved by lowering interest rates.
Yeah.
The idea of lowering interest rates is to stimulate demand, economic demand for goods and services that then boost the demand for labor. The problem with that thesis right now is GDP looks like it's growing around 4% in the second and third quarters. Demand is very strong, and yet the labor market is weak for a lot of reasons that probably defy any solution from the Fed. A lot of it has to do with retiring baby boomers, skills mismatch, a lot of inexperienced workers, and I think companies are going full bore, increasing productivity. That's why GDP is rising faster than payroll employment.
Yeah, but I mean,
Listen, the one thing he's not mentioning there, of course, is AI and how companies are now competing against each other globally and here in the US to adopt AI and machine learning and machines to do a lot of the work that people would do. And so you're seeing whole departments in certain companies completely wiped out as these companies all rush to compete. Now, the hard part here is you can't really slow this train down, because if your company's like, hey, we're going to slow down this AI and machine integration, other companies that compete against you directly, they're not going to slow down, right? Because they want the best bottom line for their investors. And if that's getting rid of some of their employees to bring on some of these AI services and products, they are going to do it. And we're going to see that on a massive level. So what do? You have to retrain some of these people. You have to open more trade schools and put these people to work in other areas where they can earn a living. Most people don't want to sit at home and get a free handout. Let me say that there are people that do take advantage of the system, and that's something that we need to address on both sides of the aisle here. But there are people that just want to go to work and earn a good living and take care of their family. And so how do we support those people that will be laid off due to some of these AI and machines to give them a future? And I think we haven't really started to look at how we're going to address that. And I think if we do that now rather than later, we're going to be in a better, more soft landing position than if we have 15, 20 million people unemployed because of all this. And those people are just, not happy, right? Those people, need to be able to support their families. They need to eat. They need to be able to pay their rent and their cars and all that stuff. And I just wish there was more conversation about that on all of these things that I'm watching. Not many people are bringing it up. What happens if the Fed does cut rates between the stock market and the crypto market? So the crypto market's obviously more important here. So let's go for that first. The crypto after Fed cuts. In prior easing cycles during the pivot periods, major crypto assets like Bitcoin and Ethereum have typically rallied as lower policy rates, QE, and failing yields, real yields, push investors towards higher risk and higher beta assets. So as rates come down and money becomes cheaper, people go and borrow that money and put those into higher risk assets, and those could be, cryptocurrencies. Those could be, I'm not saying gold is a higher risk asset, but obviously you see what I'm saying here. They're borrowing at a lower percent. They're trying to get a higher percent with some of these other assets. And that you are going to see a lot of money then dumped back into the market. I do wonder about what kind of drop off we are going to see in 2026. We can only stimulate for so long, and that is going to rise inflation. And, nobody likes higher inflation. And so even before an actual cut, rising odds of the Fed easing have tended to coincide with sharp crypto rebounds and broad altcoin strength as market front end liquidity shift. Recent moves on Bitcoin with large caps as December cut odds surge are fresh examples of this dynamic. So this is why people think that the market can go into 2026 and be positive for some time. How long? That's going to be the real question to ask here. Stocks and Fed rate cuts, we did get a little bit of that from the gentleman that just kind of broke this down. When the Fed cuts rates, the S&P near highs with no recession, U.S. equities have usually posted strong positive 12-month returns on average, reflecting cheaper finance, improving liquidity. So usually when the Fed cuts rate, the market over the next 12 months is higher. So expect some of that to happen and play out. Here's a little bit more information. Goldman Sachs gave the green light to buy the dips. Check this out.
Goldman Sachs, really has caught my eye. They are recommending buying the dips in the market. Now, stocks are off their highs. Does buying the dip right now make sense to you?
I think it does. When you look at the Fed potentially cutting interest rates, nobody's talking about them hiking rates. You look at unemployment numbers around 4%, and you look at a situation where the federal government has basically created enough stimulus that they're going to be running a $1.8 to $1.9 trillion deficit over the next several years. I think that's a very good reason to think the stock market will do well over the next few years upcoming.
Inez, welcome back to the opening bid roundtable. We indeed missed you here.
All right. One other thing here I wanted to show you is Gunran Banaji. I can't say his name. It's a difficult one. Wall Street Journal lead writer says TradeFi retail investors are becoming more active in ETFs, using leverage.
The retail investors investing in.
I think it's really been the year of the retail investor. We have never seen them quite as active as they are in markets this year. Everyday Americans, mom and pop investors, they've been pouring into broad-based ETFs. Think SPY, right? The Vanguard S&P 500 ETF. They've been buying gold. They're even sticking with the AI trade, which I think is really interesting because we are seeing some doubts creep in among institutional investors about how long this AI frenzy can continue. But individual investors, they are sticking with the AI trade and they're sticking with the stock market. We are seeing purchases track 50% above levels last year.
I'm afraid to ask this question because I think I know what you're going to say. Are retail investors leveraging up?
They are. And I feel like every time I talk to you, there is more and more leverage in the system. And we saw the downside of that in the market over the past few weeks, right? Where a lot of these crypto leverage trades started rippling into the stock market and causing volatility there. But leverage, take at brokerage accounts, crossed $1.1 trillion recently. That's the highest level in records going back to the 1990s.
And I want to be clear, and I'm not advocating anybody borrow money or take leverage to buy equities or whatever, but they've made money. They've worked. I mean, these people, for the most part, with the exception of the April tariff lows and the recent rattling we saw, I would imagine these highly leveraged retail traders have done very well.
And
they've done very well for now.
I think that's why a lot of them have stuck to these leveraged ETFs throughout the recent volatility.
Listen, leverage, if you don't know what you're doing, good luck to you, right? Just as we saw the huge leverage wipeout in the crypto market, you're going to see something very similar happen in the stock market. When is that going to happen? Your guess is as good as mine, but expect some crazy stuff next year. All right, chat sign grabber. After we soon have 7 total, now we're going to XRP, excuse me. After soon we'll have 7 total funds. Our daily volume kicks up another 35 million per day. We will be in the daily range of $75 to $80 million in average ETF share. That puts us in the range of acquiring 20 to 30 million XRP per day. What kind of average does this give us? 7 funds, 20 million XRP one day, 5 days, 100 million XRP times 4. This is 1 month, 400 million XRP, and then times that by 12, which would be 4.8 billion XRP in 1 year. Obviously, this is using current and today prices, but a lot of us are expecting the price to rise. We close out for the holiday with almost a cumulative total of 500 million in ETF volume. Incredible. We should see another 15-ish million in XRP needed to be acquired in order to back these funds. So more buying should happen here on Friday. Is the market open on Black Friday? Is the stock market open? Probably, right? I'd imagine it is. Yes, it's open Black Friday. Okay, here you go. XRP ETF daily closing update combined of about $42 million today. A lot of nice trading volume, right? The day before Thanksgiving. So even to see 42 million the day before Thanksgiving is strong here in the United States. And also there is some growing concerns around Tether. We've talked about this for years on the channel, their inability to provide an audit. And now the S&P has lowered them down even further to the weakest rating out of anything, right? It doesn't get worse for the rating for Tether. Like they are at the bottom. In this report, Tether is given a rating of 4 on a scale where 1 is the most stable and 5 is the weakest. Now they are at a 5. So this was an older report when they were at a 4. And man, it is not good.
So we have assigned USDT a stablecoin stability assessment of 4, indicating a constrained status. And this assessment is the result of a 2-part analysis, the asset analysis and also the consideration of additional factors. So let's start with the asset analysis. USDT's reserves consist of a mix of low-risk assets, such as short-term US Treasury bills and cash equivalents, as well as higher-risk assets, including corporate bonds, precious metals, and secured loans. So these riskier assets contribute to potential credit market, currency and interest rate risks. And as of the latest September report, it represented 15% of the over-collateralization ratio. There is also a lack of transparency regarding the asset profile and the creditworthiness of the counterparties holding the reserves. So this raises concerns over the true nature of the reserves risk profile. Due to these concerns, our asset assessment stands at a 4, which reflects the significant exposure to risky assets, as well as limited transparency on the reserve composition.
Limited transparency. Now Bo Hines is a part of that limited transparency. Doesn't look like he's done anything to help them come out of the shadow that Tether operates in. The S&P Global Stablecoin Stability Assessment Framework publicly covers only a handful of tokens so far: Tether, USDT, DAI, TrueUSD, USDE, assigning a score of 1 to be the strongest and 5 to the weakest. In this framework, Tether's USDC was first scored a 4 constrained and now is downgraded to a 5, which is the lowest category. Now, USDC is viewed as one of the most robust stablecoins in the market, but is based on separate analysis not published by the stability assessment like one of the USDT. And Ripple and RLUSD is not actually, they haven't given RLUSD a score either. We have seen RLUSD now breaching 1.141 billion total circulating, right? This is 1.4 billion, right? 1,100 millions is 1.1 billion. And then here is the reserve. So they are over reserve, which is really cool to see. And yeah, I'll leave it at that. I just wanted, there's some other stuff going on in the market, and I always like to keep track of what's happening across the whole spectrum of things. And I don't know if this is going to be valuable to you or not valuable to you. Can you just let me know in the description? Like Sensei, I don't really care about the stock market and what's happening here. Just give me XRP news. That would be good to know. And if you guys like these additional updates, I can add more value to them in the future if you like. So please let me know either which way. You're not going to hurt my feelings, but it's good to understand what you guys want and don't want on this channel. Your time is extremely valuable. Happy holidays. Happy Thanksgiving. I'll see you guys. Aloha.